Hello, Namaskar. Welcome you to the SAAR Analysis. I am Chaman Naik and here's my take. What if I told you that a 0.1% downgrade could reshape billions of dollars in global investment decision? Because that's exactly what has happened. Well, the International Monetary Fund has trimmed India's financial year 2027 growth forecast from 6.5% to 6.4%. Well, at first glance, it looks insignificant, but in global economics, market don't react to percentage, they react to directions. And when IMF changes its outlook from world's fastest growing major economy, every investor, every policymaker, and multinational corporation pays attention to it. Now, here's what data speaks about. The IMF now projects India's economy to grow around 6.4% in financial year 2027. Well, it's citing higher global energy prices and their impact on inflation and domestic demand. Well, there's another story to it. The IMF simultaneously raised India's financial year 2028 forecast to 6.7%. Well, it signals that it expects today's pressure to be temporary rather than structural. Well, even after the downgrade, India still remains the fastest growing major economy ahead of China, United States, European Union, and most advanced economies. And that distinction almost matters. Here's what evidence speaks about, and the evidence story isn't that India economy is slowing. The evidence story is global geopolitics tension is becoming influence domestic economic expectations. While the higher energy prices are rarely just an economic event, they are often the consequences of strategic competition, conflict in energy producing regions, supply chain disruptions, and uncertainty across the global markets. While the India imports nearly 85% of the crude oil requirement, that means every spike in oil prices immediately affects inflation, transportation cost, manufacturing margin, and ultimately the consumer spending. Well, the IMF isn't questioning India's long-term growth strategy, it is pricing in geopolitical risk. Now the question arises, why is this important? This is bigger than India because India has increasingly become world's preferred alternative manufacturing destination, a trusted geopolitical partner, and one of the largest consumer markets on earth. If India's growth moderates even marginally, it influences the global supply chains, commodity demand, foreign investment, and multinational business strategies. Well, ironically, IMF's own position also carries an optimistic signal. A stronger financial year 2028 outlook suggests confidence that India's structural fundamentals, starting from private consumption to services and investment, remain intact. Well, in other words, the challenge appears cyclical, not systematic, and that distinction is critical for the global investors. Now, here's my take. The downgrade is less about India's economic strength and more about geopolitical environment surrounding it. The biggest risk to India's growth isn't just domestic demand, it is the rising uncertainty from energy markets to regional conflict and global economic fragmentation. If New Delhi continues to diversify its energy supply, strengthen manufacturing, and accelerating the infrastructure investment, these temporary revisions are unlikely to change the long-term trajectory. But the real question isn't whether India can grow at 6.4%. The real question is whether the world remains stable enough for India to unlock its full economic potential. Because economic potential don't just predict future, they measure the confidence, and today's IMF is not a verdict on India's economy, it is a reminder that in interconnected world, geopolitics and economics are now inseparable. For governments, investors, and business alike, the next decade won't simply be shaped by who grows the fastest, it will be shaped by who can withstand the global uncertainty at its best. Well, that's all from today's analysis. I will be back with another episode. Till then, thank you for watching this.